For developing nations, global capital markets are procyclical. That means that when things go well in the global economy, capital flows to developing nations. When things go badly, capital flows out of the developing nations and goes to the advanced nations. This is what we call flight to safety. So capital is counter-cyclical for the advanced nations, and they benefit from that feature, and pro-cyclical for the developing nations. That, of course, means instability in the global economy, and it means that the textbook story that globalization of capital markets leads to capital flowing from the richer countries to the poorest countries doesn't really work. It doesn't work that way in the real world. I'm Martín Guzmán, a professor at the School of International and Public Affairs at Columbia University. Sovereign debt markets are key for governments, for states, because basically they provide a source of financing for projects that can affect multiple generations. Sovereign financing is important for building schools, hospitals, roads, etc. But the way sovereign debt markets are organized is a main determinant of the debt and social outcomes. So what we ideally want is an international financial architecture that serves the purpose of using debt for economic development. However, the financial architecture is shaped by power, not by technical considerations. And the rules of the game determine who wins and who loses in different processes of indebtedness. So that's a key aspect for understanding how the system works, understanding power. There are two key moments for understanding the debt cycle. One is the moment in which a country issues debt, the moment in which the country borrows. And ideally, the debt should be used for improving the social, the productive capacity of the country. The other moment is when things don't go well. So if a country that takes debt and in a context of risk that does badly later on, there may be debt problems. The country may have a sustainability problem, meaning that the burden of the debt payments may undermine economic development. Everyone recognizes that there is a probability that debt turns unsustainable. That's why developing nations pay a higher interest rate than what the US or the UK pay. This is called a risk premium. It's a recognition that under certain circumstances, the debtor will have troubles. However, when that moment of trouble comes, there is no system, no international system for resolving the problem of debt and sustainability. If we think about corporations or municipalities in the US, when they are in a situation of insolvency, they can file for bankruptcy. There is a legal framework with principles that makes the resolution of a debt problem of an insolvency more predictable and more efficient. But there's nothing like that for sovereign nations. So when a sovereign nation falls into a situation of debt distress and doesn't have the capacity to meet debt payments in a sustainable fashion, what it starts is a very complex process of negotiations between the debtor and multiple creditors, including the private sector, countries, bilateral creditors, like today China is an important one, the Paris Club creditors, and the International Monetary Fund. And these negotiations are, again, not determined by principles of efficiency or equity. They're determined by power bargaining. So the debtor has to bargain, negotiate with all these creditors in order to be able to rewrite the debt contracts to restore the sustainability of the contracts. And those processes can take long, and they can be very inefficient. That's what's happening right now in many countries in the South. They borrow after 2008, when the bank Lehman Brothers in the US went bankrupt, and the US created massive amounts of liquidity that became global. And after the COVID and the war in Ukraine, they began to have significant debt distress. and they are being unable to resolve their crisis. So we see a very significant part of the budget being used for meeting debt payments. And also we see that the money from global taxpayers through the international financial institutions like the World Bank, the IMF, the regional multilateral development banks, rather than being used for improving growth prospects for the countries that are now in distress, are being used for financing payments of unsustainable debts, mainly to the private sector. So this is what's going on right now. There is clear recognition today that this current system for resolving international debt crisis doesn't work, and the consequences are seen in the short term in the form of destabilizing macroeconomic and social dynamics, and in the medium and long term in terms of undermining economic development. Well, the missing piece from the multilateralism that we created after World War II is precisely an international framework for restructuring unsustainable sovereign debts. And there have been different attempts at addressing this problem, but they have been resisted by the creditor countries mostly. The last piece of progress happened in 2015. The UN General Assembly approved 9 principles that should constitute the basis of a sovereign debt restructuring mechanism. Before, we had an initiative at the IMF in the early 2000s, but there was no progress. And the real reason why there was no progress is because such a system would affect power. It would change the balance of power between the different stakeholders in debt processes. And the reality is that the current asymmetries of power favor some influential actors, mainly the private creditors. There are different sorts of asymmetries. The asymmetries of power can be seen in the form of asymmetries of information. In any of these processes for resolving unsustainable debt burdens, the creditor knows pretty much everything about the debtor, and the debtor sometimes doesn't even know who holds the bonds that it issues. There are also difference in capacity of lobbying. The stakes are high in these processes. Debt restructurings involve tens, dozens of billions of dollars, or at least a few billion in the cases of small countries. It could be more than 100 billion in big cases like Greece or Argentina. So lobbying is part of this process, fighting for the right narrative in the international sphere. And narratives affect also the power for bargaining of the different sides. The reality is that these asymmetries of power have played well for the private sector, the creditor community, the private sector community. And over time, returns have been high. I mean, there is data that shows that since Napoleon Bonaparte's defeat in Waterloo, 1813, the returns, even accounting for all the defaults and restructurings that risky countries occasionally face, the returns on bonds from developing nations have been higher, even accounting for all those situations, than the returns on a US Treasury bond or UK bond. So there are real gains and losses here, and anyone who gains with the current system will oppose reforms. But the outcomes are what we see now, inefficiencies. Countries that suffer crisis basically underutilize their factors of production. There are machines that can be used, people that could work that are unemployed, and that's not good for the system as a whole. For developing nations, global capital markets are procyclical. That means that when things go well in the global economy, capital flows to developing nations. When things go badly, capital flows out of the developing nations and goes to the advanced nations. This is what we call flight to safety. So capital is counter-cyclical for the advanced nations, and they benefit from that feature, and pro-cyclical for the developing nations. That, of course, means instability in the global economy, and it means that the textbook story that globalization of capital markets leads to capital flowing from the richer countries to the poorest countries, doesn't really work. It doesn't work that way in the real world. Okay? So that's a feature that needs to be resolved. Otherwise, globalization of capital markets ends up not being helpful for the development of the nations that are lagging behind. Okay? So for that to be resolved, we need a different international financial architecture. The official institutions like the IMF have to be part of the solution, not add to the problem. Today, the way international financial institutions work end up adding to this problem. For instance, the IMF puts charges on the countries in crisis that are not low, and it saves out of that income. And those savings build up capital. And how does the IMF invest that capital? In AAA securities, meaning that it invests those flows that it gets from the countries in crisis into the developed, into the advanced nations, adding procyclicality to capital flows in developing nations and counter-cyclicality to capital flows in advanced nations, making, as a whole, the system more asymmetric. So we need the official community, the institutions are funded by global taxpayers to play the opposite role, reducing asymmetries between the North and the South, rather than increasing those asymmetries. There are different capacities on the creditor side and on the debtor side to coordinate. Private creditors do coordinate for the determination of the rules of the game. Okay? And they do it through different institutions, different bodies, and they are successful at advancing legislation in the main creditor jurisdictions like New York or the UK that favors their interest. Debtors have a more difficult time for coordinating efforts. And there are precedents that speak of how difficult it is for creditors to sustain coordination efforts over time. One example that we address in a recent paper is the Cartagena Group in the 1980s. So Latin America had a debt crisis in the 1980s after the Federal Reserve in the U.S. increased the interest rates to combat inflation in the U.S. In the early 80s. I remember that was a time of the OPEC shock in which oil exporting countries colluded and the price of oil went up, and that triggers inflationary pressures in the U.S. and other advanced economies. So Latin American countries fell into a situation of that distress because the increase in the Fed monetary policy rate meant that the interest rates that the Latin American economies had to pay on their debts increased. So they had to allocate more of a higher fraction of the budget for meeting debt payments, meaning that they were cutting on health, education, public infrastructure, as it's happening right now in many African nations. Those countries try to coordinate. They form a group called the Cartagena Group. And it was having an impact, and it was affecting creditors. And there are reports from the CIA that tell that there were concerns, serious concerns, in the creditor community in the U.S. that would also have consequences for the banking system and for the U.S. as a whole about the coordination of debtors in Latin America. And these affected stakeholders tried to break that club, and they managed to do that. Basically, taking Mexico was the first one in leaving, and that led to it made the Cartagena Group disappear. The IMF surcharges is also a story about power. So the IMF has this policy of imposing an extra fee, an extra interest rate on countries that have debt with the IMF greater than a certain amount, or that have outstanding debt has been hasn't been repaid for a time period longer than certain threshold. And that means that the countries that have the deeper crisis pay more. Ukraine. Ukraine didn't want to have this war. And Ukraine has to pay more on its debt until the recent reform, because of the IMF policies on surcharges. And the IMF reformed this policy in last month, actually, this month. It was certainly a step forward. It means relief for several countries, but it falls short of what should be achieved for correcting the policy in a way that is aligned with the mission of the institution. But it's also the process teaches us about how power works, because there was fierce opposition initially to reform this policy. But the growing pressure from the international community led to the need for bringing this issue to the IMF board. And the whole process, with the participation of the civil society organizations, some champions, I would say, within the official community, certain governments, like, for instance, the government of Lula da Silva in Brazil, and others, the meetings at the Vatican, the role of Pope Francis, the involvement of the U.S. Congress. Some legislators in U.S. Congress even presented a bill to instruct the executive director for the U.S. at the IMF to vote in favor of reform of this policy. All that led to growing pressure for addressing the issue. So ultimately, it's a step forward, and even if more needs to be done, I think it sets a correct precedent for processes and strategies for achieving reforms that are necessary for a better functioning of the global economy.